Hello and welcome to the How to Exit podcast, where we introduce you to a world of small to medium business acquisitions and mergers. We interview business owners, industry leaders, authors, mentors, and other influencers with the sole intent to share with you what it looks like to buy or sell a business. Let's get rolling. And now a moment for our sponsors. I want to highly recommend you get Acquisition Aficionado magazine. Every month, Acquisition Aficionado magazine brings you tactics for business buying and selling you won't find anywhere else. Learn firsthand from industry leaders who share their success stories, featuring in-depth interviews and stories from leading figures in the business acquisition industry. This multi-platform mobile magazine speaks to acquisition entrepreneurs wherever they are in the journey. And I want you to visit acquisitionaficionado.com today. Hello and welcome to the How to Exit podcast. Today I'm here with Michael Mufson, and he is an investment banker, a fairly seasoned investment banker. And today I want to thank you for being here because we're going to talk about what it is. What do we do when we succeed? A lot of you guys out there, you're out there, you're doing your roll-ups, you're doing your thing, and when you win, and it's time to have that succession plan, it's time to sell it. This is the type of gentleman we need to talk to, and you've got a lot of experience in this realm. Thank you for being here today.
My pleasure. Thanks for having me.
All right. Well, let's start with your origin story. It's the ongoing joke. If you said you listened to some of my episodes, you know I'm going to ask you, how in the hell did you end up on a mergers and acquisitions podcast? Tell us your story. Like, what got you into the space? And you've got a really cool career in this space. So, tell us about that a little bit.
Yeah, I was fortunate when I graduated from undergrad. I was working for a U.S. senator. I went to George Washington University undergrad, and which is in downtown D.C. and Foggy Bottom to be specific. And then while I was at the Senate, I decided to get an MBA at the same time. And I was finishing up my MBA, and my senator lost. He was from California, John V. Tunney, the Honorable. And I had to go in the real world. So I joined Ernst and Young in their consulting group and got my CPA at the same time. And this is like 1981. I'm an older guy. And the markets, I think when I joined an investment bank in Philadelphia, which is called Butcher and Singer, which has now been rolled up into Wells Fargo, the Dow was about 900. All right, 900. And inflation was just starting to come down. We had mortgage rates at 18 and 22%, and the bond markets were crazy, and rates were coming down, and all of a sudden the valuations were going up, and companies were going public, and we were doing what's called underwriting. We were doing IPOs for family-held businesses, big family-held businesses that were making bottles, steel. There wasn't an opportunity for companies to go public. And I'm telling you this because of a particular reason where the market is today. So if you had a nice business back then and you had just a million of after-tax net income, you could go public. And I think there were 17,000 public companies in the U.S. at the time. So that was the thing to do. If you needed liquidity as a family, you went public. There were no private equity funds. There really wasn't a market to sell businesses other than companies and industries knew who was going to buy them. There weren't private capital like there is today. So that went along pretty well from about 1981 to 2001. And we went through the internet. First, we went through PCs. We were taking them public, companies that make PCs. And then intranet companies that were tying together computers in offices. And then the internet came about. And all of these things were massive capital requirements to fund, and the public markets were doing that. Well, come around 2001, we had 9/11, and we had a hot IPO market. There were regulators that were determining that, the widows and orphans weren't getting the hot IPOs. I use widows and orphans as a term of love, meaning that the retail market and the big institutions were getting all the benefit. And happened to be Elliot Spitzer in New York, who was the attorney general, did an investigation. And we, as an industry, were regulated by, at the time, it's FINRA now, it was the NASD back then, on behalf of the SEC. And that whole infrastructure of companies to raise growth capital ended because the regulations got overburdensome and all that risk capital left the growth markets. Fidelity had a big fund, MFS, and everyone had Vanguard was, and all that money went into all the pension funds started going into private equity. So what happened in the first 2003, 2005, 2010, private equity started growing. And private equity was buying family held businesses, closely held businesses, divisions of companies that public companies didn't want. And then that became a multi-trillion dollar asset class. Today it's a mature industry. So I followed all of that. And my background, joining an investment bank, being a CPA, back then they hired me because I was able to do something called pooling of interest and purchase accounting. That's when you merge companies. You don't do that anymore. But it was, a little tricky task to be able to do it. I was an MBA CPA. I was able to do that, and that's how my M&A career started. So looking back, I had a great vantage point, but we followed the money all the way. And today, companies that are being bought by private equity would have been public companies today. I don't know how many are left public companies, but if it was 17, 18 back in 1990, it's got to be a third of it today because people are going private. Nobody wants to be public. It's a burden, and it's only for really big companies today. So typically, you need to have about a $500 million pre-money valuation to be public today, and that's a good-sized company.
I get it. Good news is you were an attorney. I mean, you were a CPA way before the
Yeah,
Sarbanes-Oxley and those things. Where I
yeah,
used to
yeah,
joke with my friends because when I was doing my MBA, I was trying to make the difference. I'm going to go to accounting. I'm going to do marketing because I wanted to be an entrepreneur. I knew I wanted to be an entrepreneur. I was doing my MBA to get out of tech management because I was in the .com world and I was managing big tech divisions of companies, and I wanted out of it. I was burned out. And then all this stuff rolled out, and I started thinking we had this show could be a CPA, go to jail because of Sarbanes. There were some real consequences for making
yeah.
mistakes after Sarbanes-Oxley and some of the stuff you were talking about. So it made the whole like numbers game not sound nearly as fun.
I didn't even address Sarbanes-Oxley, which was an overkill
Hmm.
for smaller companies. So, and it really ramped up the cost of being public. And smaller companies weren't able to take advantage of it because they weren't able to tap the capital markets. And they had all the bureaucratic requirements for being public. So it was two strikes.
I don't want to make any illusions. I'm your typical capitalist guy. I want to make money and stuff, but I believe that our public market has an inherent flaw in that you could take a company that's generating $100 million a year in profit, EBITDA, STE, whatever you want to call it, year after year, and if they did that and they never moved forward, their stock would go down, and the CEOs would get replaced because they're not growing, and that just
Right.
is illogical to me that somebody could be winning the game, steadily holding a market in a changing environment in an inflating market and stuff, and managing to keep at that. $100 million is a very profitable company. They're employing, hundreds of people at that stage, especially on the profit scale. But in the public market, you don't grow, you die. You don't grow, you get fired.
Exactly. If you don't grow, you don't increase value. You don't increase value, people are going to lose interest. They lose interest, stocks go down. So yeah, that's why the rule of thumb in public companies is you're going to grow organically 5 to 10% a year, and then acquisitions are going to give you another 15% growth. So you have to, if you're public, you have to, unless you have a product that is just growing double digits and will be for the foreseeable future, you got to make acquisitions to survive, which is what's good for an M&A practitioner. But most of the activity in the middle markets and we call it the lower middle markets are it's private equity is driving it through what we call tuck-ins. They have a platform and they buy smaller companies to give them geographic reach, give them new products. And you talked about your audience that are buying up businesses, and at some point in time they're going to need a liquidity event. And in order to do that, that's really what you need an investment bank for, which, it takes a little army to sell a business. It's complex. There's a lot of documentation, and you need to know the kind of the rules of the road a little bit once you start going out, because guys like us tend to be gatekeepers. You can pick up the phone and call Mr. XYZ private equity firm, and you could probably do a deal. But we like to tell people, you're going to be an expert after you do your first institutional deal. You want to be with a group of people who they're not learning on your task. They've done it, scores and scores of times. And that's why people hire investment banks.
Yeah, I know. A lot of our guys, they're out there. They've been doing this for 6, 7, 8 years. They're getting to that point. I was telling you before we hit record, I was talking to somebody. They're getting close, right? They're pushing $100 million in revenue. They're probably looking at. They're happy with doing what they're doing. But I asked him how long. It's probably another 5 or 6 years. And I said, okay, what's your succession plan? Because we all know it takes a couple of years to get it right, to prep yourself for a proper exit, at least in the small business world. But if you start thinking about start thinking about it that 3 to 5 years ahead of time, and he said he's been building it to sell. But one of the things he said to me was like, I'm going to give my broker that sold me the last three a shot at selling this one. It's like, oh, whoa, that's the wrong guy. In my mind, you hit past, I say, $5 million in EBITDA, you're no longer calling your family broker. You're not calling somebody off a biz buy sell. You're calling, that's a lower end for the investment banker. But you start talking to investment bankers when you get up there, because it's an entirely different process, right? Much more competitive. You're talking about strategic buyers, people that are public. You're telling me earlier, the teams are way more diverse. You're going to have way deeper due diligence. So walk us through that a little bit. What does it look like? I come to you. I've got a company I've been building for 8 to 10 years. We're there. I don't. This is hypothetical. I'm not there yet.
Yeah,
But hypothetically, let's say we're churning up. Let's make the numbers easy. 10 million. 10 million in EBITDA. We've got our systems and processes down. We've got our management team in place. We've got good accounting. We've already had our books. Maybe we're starting to look around for a company to audit our books or something. What does that look like walking in the door with a company or somebody with your skill set?
sure. So you said the magic metric, 10% EBITDA margins.
Mm,
So if you're 100 million, you want to be doing 10 million of EBITDA. But EBITDA is, we talk in adjusted EBITDA.
right.
So there are, which I'm getting ahead of myself, but put a pin in that and I'll come back to adjusted EBITDA. But what you want to be able to do is ideally have, at the very least, reviewed financials, even better, audited financials. And typically, if you have a bank loan of any size, and if you're at 10 million, you're going to likely have audited, but not always, reviewed, that have notes to the financials. And so and then what has become a standard in our world is something called a sell side quality of earnings report. And a quality of earnings report is an addition to reviewed financials or audited financials, which basically bridges GAAP, generally accepted accounting principles, to cash, EBITDA. So now we hire firms to do quality of earnings. So before we go out, we'll have reviewed or audited financials, and there'll be a quality of earnings that reinforces what EBITDA adjustments are. So adjustments to EBITDA would be, biggest one is typically compensation. I have a firm, 100 million, 10 million of EBITDA, and let's say I have an annual capital expenditure budget of a million. That's 9 million of cash that comes in. I'm probably giving myself a $5 million distribution, and I'm paying myself a really high salary. So what we do is normalize things. So privately held companies, typically the owners make a lot more, and the senior management, than many public companies. So what you want to do is annualize your comp as if you were at a public company, or what the market will bear. So if you're paying your CFO $500,000, he or she would probably be more, for a company that size, 250, 350. So all that comp gets added back. Also, many times people expense capital expenditures, don't amortize it. So we'll go back in the quality of earnings, and we'll capitalize it, and we'll put back. We'll spread it over 5 or 7 years rather than 1 year. So obviously you get a benefit to that. So there are a lot of adjustments that take place. But your question is why we do all of this is because we do the due diligence that a seller would come upon, from accounting, product. One thing you don't want to have is, I mentioned audited financials, reviewed financials, the quality of earnings, and then you want 10% EBITDA margins at a minimum. And that seems to be what institutional investors, if you can't get 10% EBITDA margins, that means your gross margins are too low, most likely. Low gross margins typically mean you haven't built a moat around the business, that people don't pay enough for your product or service. And so that's where that one comes from. But you want to make sure your business doesn't have customer concentration. That is the proverbial kiss of death. The good news is Walmart's 50% of my revenue. The bad news is you got customer concentration, but it's great if you're a private company. But institutional investors are going to put such a risk weight on that. And I can tell you, doing this, always after you sell the business, the next year that big customer decides to pull back on you. So you want to have multiple customers. You don't want to be dependent upon one supplier for your product. If you have an environmental problem because you've had tanks underneath your facility for 25 years, you're going to have an environmental problem which has to be dealt with. And you need to have employees who are, not all your age. You don't want everyone to be 65 and 70 when you sell the business. So you need to have people in place to continue, because in order to create value, a lot of people think they're going to get fired. No, they're going to get employment agreements, and they're going to want them to stay for a while. So what we do is really come in and beat up the company so we can withstand the due diligence. And most importantly, we tell our clients what the valuation would be in the market, what the terms likely will be. And we know this because we're in the market all the time. We're talking to hedge funds, strategic buyers, where we know how they value the business. And we, after doing all that due diligence, typically have an auction for today 150 potential buyers. When I started 30 years ago, we went out to 10, 15 people. Today, it is well over 100 people. And that is like why the art world has seen such an appreciation in art, because everyone on the internet's bidding on it. It used to be, you had to be, old school, you had to be in the hall or the location. And then the telephones improved that. And now the internet is a worldwide auction. We do the same thing. We really go out to people who bid on this. And it's international today. A $5 million EBITDA business can go around the world in an auction. There are buyers all over the world, and that's what we do. And that's why people pay us the big bucks to do it.
Yeah, I know that that's the huge difference too, where a small business broker is gonna make a listing and put it on Biz Buy Sell, share it with some friends and stuff, and hope somebody comes along. You guys actually go out and actively seek who's buying this type of company, make introductions. If you've been doing it as long as you guys, you already have a Rolodex of knowing who's buying what. You
Yeah,
have people in your company, that's their job, to really understand who's buying what and for what valuation, so that when somebody comes along, like a plumbing or heat and air roll up doing $5-10 million EBITDA, you kind of already know in your head, okay, here's the 35 companies I'm going to reach out to, and hey team, call these 5 private equity. It sounds like they're getting into this space too. You've got that, you got your finger on the pulse of the space, and it's more of an active marketing. It's an out, you guys, or when I say you guys, I'm classing all the investment banker, you actively market these deals to potential acquirers, both strategic public companies and private equity.
right. We do. And, you kind of play the gatekeeper role and you develop relationships. That's, our value add is, in addition to doing all the aforementioned work to make sure you're going to sell and stand up to the scrutiny, because our greatest risk is you get shredded in due diligence. So it doesn't make us look very good. So yeah, we put, once we've documented the company, we put a teaser together, and that's when we'll talk to 120 of our best friends to buy if they're interested, and it's all cloaked with a project name. If they're interested, they get an NDA, And then if they sign the NDA, we negotiate terms that are acceptable to our client. We send them what's called a SIM, confidential information memorandum, and then we give them 3 weeks to review the SIM. We ask for something called an indication of interest, which is what I'm willing to pay, what are my conditions to closing, and my ability to fund. We won't, typically don't work with groups that don't have funds, meaning they have a dedicated fund to buy, or it's a public company that we know that's the cash. And then we typically, the yields can be anywhere from 10 to 20% of who you went out to. So it's not unusual to have 20 IOIs from that, or 15 IOIs. It all depends on the markets. If the markets are good, you're going to get more. If the markets are tight, you're going to get less. And then you pick 5 to 8 people to have management meetings. After the management meetings, we'll get letters of intent. Letters of intent will have about the only thing binding on it would be the exclusivity period to do due diligence. We'll pick someone and hopefully close. All of that can take 7 to 9 months from start to finish.
So it's not too far off from the lower market where it's 3 to 5 months, 3 to 6 months if the SBA is involved, right? I've seen people doing it in 3 months, 90 days. That's a stretch. That's a
Yeah.
tough that's a quick process inside of that realm, but so it's not quite double, but it makes sense. So it's a much more complex deal. And then how are these deals funded? I know some banks, I mean, some of these public companies, they have cash, they have stock. We talked earlier about institutional funding. Are some of these guys going through bank funding also? They're taking a
Yeah.
certain percentage of loans from banks and then funding it. Cash is
Yep.
king. All companies want to reserve as much cash as possible and use as much, affordable other people's cash as they can.
Well, the better companies, people that want to buy, typically public companies, just come to closing with cash, whether they fund it through a bank line or off the balance sheet. Private equity, they tend to will use either a commercial bank, but there's something a tuck in. If it's a platform they have, like HVAC, and they're buying a regional player, that's a tuck in, and they're going to use bank debt for that. If it's a platform company, meaning I'm buying my first HVAC company and it's a big one, they typically use private credit funds because banks tend to be a little restrictive in leverage. So private equity today, it's probably 50-50. If they buy something for 50 million, 25 million of it will be out of their fund, the equity, and half of it will be out of a bank or a credit fund. And they have well established relationships, and they're doing the due diligence for their equity LPs. The bank is doing their due diligence. Many times, in addition to a bank, you're going to have a sub debt fund in. So you'll have the equity, you'll have a mezz fund or a sub debt fund, and on the senior, you'll have a credit fund or a commercial bank. So you got a lot of players, and they're all doing their due diligence. And you hope it all comes together so you can get to a closing.
I'd say I've interviewed a couple of people recently who have done private placement memorandums and raised funds. Two of them actually raised debt funds, which prior to talking to them, I didn't even know that was such a thing. That it wasn't was. I always thought when you raise money, you have to give away equity. And both these individuals, one of the things I think that was unique about both of these parties is they had really unique stories to tell. So in this time and climate, I think that helped them raise money as fast as it did. So one of them, they're buying assisted living facilities, veterans homes, care facilities. So they're housing and drug rehab and stuff. So they're housing homeless veterans, they're housing the elderly. It's not too hard for them to raise capital when they can go to the fire and pension funds and the other stuff and
Yeah,
go, hey, we're taking homeless veterans off the street, cleaning them up and giving them a place to live. The other one was really creative. I just interviewed them. They raised 225 million. Their story is they're taking an industry that is predominantly male driven, but female customers, and guarantee the investors that when they hit a certain point of EBITDA, they're installing an entire women based female, I don't know what the politically correct term is, but board of directors. So the CEO and C suite. So the C suite would be all women ran. They're going to take an industry, and the investors ate that up because it's something that that particular industry needed. One of the cool things they did is, they have a private equity. They raise capital from like family offices, other private equity firms, but they have a backing from institutional lending that will lend up to, I think the number was like 60 or 70% on a deal. And then, so now they only have to tap into the fund they raised for the other portion. How does institutional lending work? How does a person who's out there raising capital start those relationships and start those conversations?
Good question. And you said something that was critical. When you do something, let's say you buy a candy store,
Hmm.
and then you buy a second candy store, and then a third one. Now you're starting to have a trend, and you're showing that you're able to improve margins, cut costs, integrate them, and you start getting credibility that you can manage third party money. And that, so a bank will be, attuned to that. If you have a bagel store and it's killing it, and you want a second bagel store, it's going to be hard to get bank debt on that one unless you personally guarantee it and aunts, uncles, doctors, parents help out. But now you get into store 3 and 4, you've got a brand and you've got systems. And so at that point in time, the banks and the institutional credit markets are going to say, you're probably worthy of our capital at this point in time, whether it's senior debt, sub debt, and you build a record showing that you're an honorable borrower, you're a good trustee for sub debt, which is kind of more like an equity instrument, basically, and without giving up the equity, but it's a different underwriting standard. So you're building a brand, a name, a reputation, and it just keeps going and going and going. And you need to be a good Eagle Scout type of investor, lender, or accepting investments, and a good fiduciary. And as you grow, you're going to get people running after you. But you have to build, you got to show that you're institutional grade, that you're someone good to bet on. And it's hard to do it the first time you've never done it. It's easier the more you do it.
It's interesting you say that because now you said that both the parties I know that raised debt equity have a history. One of them already holds 30 entities. This is a new project, but he has a proven track record. He has 30 entities that he's a part owner in that he's acquired over the last 20 something years that he still oversees and runs. And the other individual, the other that raised quite a bit debt equity, he's been acquiring those assisted living facilities and homes for a long time. He teaches other people to do it. He has a few dozen, acquires 1 to 2 a month. I mean, he's really active in the space, so he's got
So
the
he's got to
reputation.
have a good
Yeah,
reputation. I mean, that's, it's a highly regulated space. So you've got government reimbursement, and you just need to, if you've got that many units and you're operating them, you're pretty good.
yeah. So that's an interesting way to look at it. So let's go back to the acquisition entrepreneur
Yeah.
who's he's acquired, say, his 10th acquisition. He's starting to look out what's the timeline do you think it takes? So in the small to medium business world where you always tell people start planning for your exit 3 to 5 years before you need to
Yeah.
sell. What's the timeline to get ready to sell through the investment banking process? Is it the same or
Sometimes we meet someone. I love it when we meet someone. They say, "I'm ready to sell." We say, "Great, let's do it." But no, typically it's a long-term relationship because you're relying upon someone like ourselves as an advisor. And once you start getting, like 2.5 million of EBITDA, you're typically starting to get to be a big business. And around 2.5, you're kind of considered maybe tuck-in territory for people. You start getting up to 5, depending on the industry. So you want a good CFO. I mean, you need to have someone, you need to know your business. The only way to know your business is someone who is really keeping good score and is controlling what's going on. And so you need to have a good CFO or a good controller in the company. So you can't start that one too early. And, it's less expensive to start with reviewed financials early on. But today, QuickBooks we sold a business that had, they had 20 million of EBITDA and they were on QuickBooks. So did it help the process? No, we had to have a big quality of earnings study done. But that's a rare exception. But, you want someone to come in sooner than later because it, again, shows good judgment, and you have a controller, CFO who knows helps you know the business and is helping you control expenses.
There's a couple of new players in the last 10 years or so that are out there. What do the big guys expect you to be running on accounting software? So if I'm thinking about exiting, I'm outgrowing QuickBooks. There's like I think one of them Zero or something like that. What is people that
Yeah, I don't, there are a whole bunch of systems. Each industry has their own
okay.
systems right now. Some of them are ERP kind of systems, enterprise wide systems that include accounting and manufacturing. Great Plains, I don't know, out there, they were have been acquired. I don't know the names any longer,
Mhm.
but it tends to be more industry focused. If you're doing something in steel servicing, they're working on something. If you're doing something in distribution, they've got their system. So it's it's pretty industry specific. And then there are other people that have, very detailed accounting systems with a lot of divisions, subsidiaries, and they're using, you know, but QuickBooks isn't too bad. It gets, depending on the business, you can get pretty far with it.
Yeah, I believe so. I'm small enough. That's what my people use. I'd say what I use, but I don't touch any of that. If I touch it, I
Yeah.
mess it up. That said, what is the next? So they get their accounting system right. They start to get a CFO in place. Is it too early, like at that stage, to go ahead and start building what a data room would look like? Are you starting to collect and update?
Yeah, I think that's a little early. I mean, one, it's expensive to maintain. I know companies that
Hmm.
do that. They get a virtual data room, which is a
Hmm.
service, and they start putting corporate documents in and leases and employment agreements. But I think that's a cherry on top of the sundae. That can be done towards when you're ready to hire someone. But the fact that you have all that documentation there is important. So most people, it's supplier agreements, anything to help you run the business, you want to have documented. But the accounting is certainly key. If it's if it's a regulated portion of your business, OSHA and the other government agencies you have to comply with, and payroll systems, and you want to make sure you're compliant with certainly taxes. It doesn't look very good if you're not good on your taxes, certainly payroll taxes and the like. So you just want to run a good business that someone can look at and say, yeah, they're pretty diligent and run an honorable business, because that's what big, and it's a fiduciary buyer, a public company, a private equity fund, they're going to look for. They're going to look for the character of the people at that company.
I've already had one of my first run-ins was I thought I'd landed a pretty good sized company right off the bat. They were doing 15 to 20, depending on the year, million in revenue. Their EBITDA's really horrible because they were managing it horribly. But I was looking at them and a company right down the road that built 30 miles down the road that built a semi-competing. Their products overlap by one product line, but they built a suite. They were half the size, but they were running at 30% margins, and it was for sale. I was gonna buy them both and have the team from the good run one come over and help me run because they were 30 miles apart. And the bigger of the two companies, I mean, we had LOI signed, they agreed to it. I agreed to take over their debt. They owed the IRS 960 million, or I'm sorry, $960,000, nearly $1 million. And they went to the IRS and said, "Hey, this company is going to buy us. They're going to assume that debt and take over this." And the IRS like, "No, they're not," because they were on a quarterly meeting with the IRS, going to work out agreements. So once a quarter, they had to meet with the somebody from the IRS and like continue on payments and do other stuff. And they never can. So one of the reasons the IRS just said, "No, you're not transferring this asset." So they nixed the whole the whole sale. One of the reasons I was interested in it because I think we could turn it around, and their books were such a mess. They've never even contested the IRS claim of what they owed, and I had found a forensic CPA team that could have cleaned up the books. They honestly, just by looking at what I could give them, thought they could challenge that, bring that way down. And they had a law firm, the law firm that owned the forensic CPA team, specialized in negotiating IRS debt. And I already paid. I thought we had the LOI signed, so I'd already given them a $6,000 starter retainer and like had them start to look at things. And when the IRS said no, I just told the ladies to look. I already paid the retainer. Chances are I won't get that back without fighting them. Why don't you call over there and get this straightened out and renegotiate this thing? and I haven't heard back. Probably should, because the whole goal was that she gets it fixed and come calling me back.
One thing that we haven't spoken about is how you value businesses.
Okay.
And I would say where ignorance is not bliss is a lot of people come in and say, "Oh, I want to sell my business at 20 times EBITDA." I said, "Really? Okay." And that's what it's worth. And I'll wait until I can get that number. And they're really, because they heard someone else bought something for 20 million. And a lot of the statistics are not in the public domain. Unless you have to report it as a public company. Buying a private company that's big enough, because of disclosure rules that hide most of the data, it's just by talking and knowing. But I mentioned something that private equity, when private equity can leverage a company 5 times, and I said it's 50-50, you might get 10 times for that business. But when leverage is at 4 and 3.5, you're not, it's very hard for a ordinary business. People get those kind of valuations are, companies that are growing at 25, 30 for consistent years, because growth is how you create value. EBITDA allows you to fund. And if you have a good stable EBITDA that's growing greater than gross domestic product, GDP, the valuations are just not that crazy. Big companies get big valuations because they're big and they can borrow enough. But us mortals in the smaller, if it's a small shop kind of a business, you're selling a business with purchase money. So they're taking debt, there's earnouts, and cash is not going to be 100% of the acquisition. And as you get bigger, that changes. But a lot of people have ignorance on valuation, and they really need to become informed and understand how these deals get financed and how the financing really pushes what the valuation is going to be.
Yeah, I always tell people is very rarely does the first guy who talks to an off-market seller in the small to medium business world get the deal done, because the off-market seller is looking at, he's going to Google, he's got, what is my heating and air company worth? And they pull down those sheets from the colleges that says, well, heat and air industry gets a 12 times multiple. Or like, well, I want 12 times my, I paid myself 100,000 last year. I want 1.2 million. And I was like, okay, it doesn't work out that way. There's different tiers in this. You're looking at something that is usually geared at high private equity above $2 million in EBITDA, maybe even above, $5-6 million in EBITDA. Those numbers those colleges are giving out are not your world, and they have to hear that from two or three potential buyers before they believe it.
I don't know the statistic you're referring to, but you look at there's a linear relation between size,
Hmm.
and companies below 5 million of EBITDA tend to sell at between 5 and 6.5. And if you get above 5, you might to 10, you might be 6.5 to 7, and you get above 10, and it's primarily due to your ability to finance,
Hmm.
because small is risky, larger is less risky because you have a bigger base, and if you lose a customer or two or a service or something, you're not going to devastate and default on debt. So people need to understand that. I can't tell how many conversations we've had with people over the years that we just can't get through, and they don't want to understand how companies are valued, and those companies tend not to sell. You know,
I was looking, I told you I have before we started, I told you I owned a little pest control company. I was
yeah,
looking at a bigger pest control company that would serviced all the lake resorts, and they primarily did mosquito repair. I mean, mosquito repeller. They have spray systems that hook up to the houses, and at 3
yeah,
a.m. it sprays. I was like, you're one EPA decision or one, state agriculture decision that says you can't spray that chemical away from being out of business. You got one product line, right? I'm not that interested in that, because they've thought about it a couple of times. I already know that it came up, that the question has came up. Is that leaching into the lakes, and is it dangerous to the aquatic life in the lakes? And there's so many rules and regulations. You're one one board decision away from losing $500,000-600,000 a year. It was a small company, five six hundred thousand
right.
dollars a year in EBITDA, and you only have that. That's the only product they did. They were mosquito control. And I was like, maybe if you had half your business in town away from the lakes and the waterways, and because that's where it really comes to play. But you got to look at all these different things.
So yeah, those are the kinds of things you need before you sell to understand
Yeah.
how to remedy it and how to protect a buyer from that kind of a risk. But you mentioned mosquito service up in a lake community. Well, the lake community might not do well. Recession is going to cause people not to rent homes.
Mm.
It means they don't use the service. So that's why you want a company that has they're in multiple geographic locations where some event won't cause uh, undue risk, and that's what I was referring to. Larger companies tend to have that, and when you're building a business and you're trying to create maximum value, is to have that kind of in your not having all your eggs in one basket. A restaurant chain that has 20 stores that are all in Philadelphia is not going to be as valuable as a good restaurant chain that is up and down the East Coast. It's just logic.
Yeah, you're one natural disaster away from being out of business. So, what is the process to kind of go through this? If my guys are out there, they're listening, they've been doing this for 7 to 10 years, they're ready to talk to an investment banker. How early do they start working with you guys? Do you start like early in the process and groom it and coach? Is there some type of consulting, or is there a different type of advisor they need?
There are firms that will do that. We play the long game.
Hmm.
If we meet a company that we know the industry well, we'll say, let's meet. We just met with a sensor company that is about 2.5, 3 years away. One of my partners in the industrial space. We like it. They need to grow it. They're doing that. We told them, if they need some growth capital, maybe we'll introduce them to some people. And we told them exactly, what they need to do in order to maximize their chances for a sale. There's some customer concentration they need to kind of wean off of this, and they have some products to do that. So, it's talked to a bunch of investment bankers. It's a highly personalized service. So some people like us, some people don't like us. And if you meet enough people, they should be all saying the same, relatively speaking, on process, valuation. But I would say, once you're a million or so in EBITDA, 2 million of EBITDA, and you're growing, and you want to acquire companies, and you want to be able to get additional relationships in the credit community, whether it's credit funds or banks. I mean, investment banks, individual will make those introductions, and many times they do it just for goodwill with companies. At least we do.
Yeah, I was just talking to a guy who's acquired. They're on their seventh, and talking to acquired their seventh multi-million-dollar manufacturing industry type of company, and they're talking to. They're in LOI, I think, with two right now. So you got 8 and 9 on the hook. They don't know. You never know when they'll close. So, and they're at the point now where people in that industry call them, right? They've
Yeah,
acquired enough. They're running them successfully. They're improving upon them. They're growing them. They've got a name for them, and he's talking. Okay, it's about time he's going to have to go out and raise a fund.
yeah,
And like I think he's at the right spot to do that. He's got the track record. He's got the history. He's got a heck of a community, both online and offline, that know who he is and what he's up to. I think that's what it takes in this day and time to raise capital from the both institutional and from private equity.
yeah. No, if you look at the progression, it becomes kind of exponential. The incremental dollars, once you get to 8, 9, and 10,
Hmm.
you're starting to make some serious money. And if you're showing that you're able to improve operations, you're, golden, and you're going to attract institutional money.
Awesome. So I've asked a lot of questions. I feel like I'm asking questions here, but I feel like I'm missing things. Where are we? What else? What else does somebody out there in this space need to know before they enter into the world of working with investment bankers?
Well, markets come and go. So what you hope is their life cycle and where the market is are aligned. I mean, there were a lot of companies that were sold during COVID in the consumer space that were killing it. And today they're off, 20, 30% in revenue. Companies were selling back then. We were home buying a lot of consumer products. So, knowing the markets, when things are good and when things are early in the cycle, not late in the cycle, you want to time it to be when the uptick occurs, not when it's flatlining up top. And you run a business. Every industry has their own nuances, and when it comes to selling businesses, talk to people like myself and learn. I mean, there's certainly enough of us out there, and find someone you like, and someone who wants to make an investment in you. Our business is incredibly competitive, so typically when you get a sell mandate, as we call it, we're pitching, three, four banks with us. And hopefully the goodwill you did previously and the knowledge and the relationships you develop with the owners is going to prevail. But it's a bitch of an industry. It's very competitive. There's so many good players out there.
I bet there is. You're talking about industry cycles. I know when I was in the real estate, we kind of looked at one guy will tell you there's a 15-year cycle in real estate. Most people tell you there's a 20-year cycle but it's cyclical. A lot of these other industries seem the same way, right? If you miss your window to sell, there'll probably be another one, but it may not be, but for 5, 10, 15 years down the road.
I remember my first in 1987 was my first market correction,
Hmm.
and I think it lasted like 9 months. I mean, right now, interest rates have such a role in people's perception of the market because you're borrowing. But right now, people have accepted, investors and institutional investors have accepted that we're going to be in a higher interest rate environment. It's baked into numbers. Valuations came down a little, but the credit markets, there's so much liquidity right now that between what we call liquidity in the market, unspent capital in private equity, in credit funds, and of course the banks and cash on corporate balance sheets. We're swimming in capital. It's got to go somewhere. And so right now we're starting to see it pick up a little bit. It was second half of 2023 was awful, but things are picking up again. They're not in like these kinds of cycles because everyone is making independent decisions. Do I pay up now? Are things going to get cheaper? These are the buyers, and the sellers are things going to get more expensive? Do I? But when you've got good numbers and you've got growth ahead of you, you don't have customer concentration, and you're at an age where you really want to get a liquidity event. I mean, you need to be at a point where you say to yourself, I've got all my wealth tied up in this capital. I've been at it a while. My family and I deserve some liquidity. And if all of the things qualify, you ought to be out starting to talk in the market. And it might be, another 18 to 24 months before you're able to do anything, but at least you're talking, learning, and getting comfortable with the process.
Interesting. When the interest rates started going up, I knew that there was going to be a downturn in like activity, but also it was telling people just hold on because it won't. Everybody's like, we'll just have to wait until the interest rates go down. I'm like, no, you'll have to wait until everybody gets acclimated to the fact that they're going to stay
Yeah,
up because money has to move. The people, all that liquidity, it doesn't make money sitting idle, right? Not the kind of money they needed to make. So they have commitments and promises to the holders of that capital that especially private equity and stuff that they're going to earn something on it, so it has to move. So now they just go back to the drawing board and rerun the numbers and figure out how do we make this interest rate work,
right.
right.
The dry powder, you use it or lose it.
Right.
And, at some point in time, you're going to rationalize spending that on assets. And buyers are very, very particular. So in markets like we're in now, a great company is going to get a lot of interest. A company that isn't has some issues,
Hmm.
it's not that kind of a market yet. But when a frothy market occurs, people are buying. So we're not in a frothy market, but we're getting into a better market right now.
Well, I appreciate your time. I want to respect your time. So let's wrap this up with this. If somebody could remember only a couple things from this conversation with you, what would you want them to takeaways to be?
Be prepared, talk to a lot of investment bankers, and understand the rules of the road when you're going out to sell your business. And if you get a bunch of people that tell you the consistent things and you don't believe that, well, then you're probably not going to have success.
Well, thank you for being here today, and I think we'll call that a show. Before we do, if somebody wants to work with you, want to reach out to you, what's the best way do you want them to contact you?
Go to our website, www.mhhco.com, mhhco.com. There's my email address is on it and other partners here. We're about 18 people, and we'd be happy to chat with you.
Awesome, and I'll put that in the show notes for you guys that are driving or you're listening to this on your commute or something. Don't don't swerve and try to write notes down. It'll be in the show notes for you to look up when you get to your destination.
Well, thank you for having me. I enjoyed it.
Awesome.
Thanks so much.
Cool. I want to announce our new channel partners, the ITX Marketplace. Since 1998, ITX has created $5 billion in value by selling more than 225 IT businesses in 20 countries. ITX works exclusively with IT-enabled businesses generating between 5 million and 30 million who are ready to be sold, and M&A decision makers who are ready to buy. For over 25 years, ITX has developed industry knowledge that helps determine whether a seller is a good fit for their buyers before making the match. ITX Mergers and Acquisition Marketplace we have partnered with has a proprietary database of 50,000 plus global buyers seeking IT service firms, managed service providers, Microsoft service providers, software as a service platforms, and channel partners with Microsoft, Oracle, ServiceNow, and the Salesforce space. If you have an IT enabled business you're ready to sell, I want you to visit the itexchangenet.com/marketplace. How to exit. That link will be in the show notes. Visit them now.